Hello, welcome to the Joe DeLisi Financial Advisor Podcast. I'm Joe DeLisi. I want you to be honest with me. Are you a little worried about opening up your statements, your investment statements? We're going to talk about that today. I had a meeting with a pretty long-term client yesterday, and we were going to review his path. He's got about a 4-year time frame, roughly, to when he exits the workforce, corporate America. And I said, look, we're going to review that. We're going to go through all of the normal stuff, what accounts are going to pull from and when, how he's going to pay for private medical insurance, all this kind of stuff. And I said, then we're going to look at your portfolios. We're going to walk through how they're doing and answer any questions on that. And he's like, no, I don't want to do that. I said, which part? He said, I don't want to look at the investment portfolios. I haven't opened up a statement all this year. I'm scared to death. I don't want to see it. And that caught me off guard because usually people want to look at that. And I said, man, you're fine. You're better. I got good news for you. You're way better off than you think. You've probably been listening to the news, which is a horrible mistake in this environment. And I'm going to have some good news for you today. And so we had that meeting, and it got me thinking, how many of my clients are doing the same thing? How many of you out there don't want to open up your investment statements because of the scary news that's out there? So, look, this is really a podcast today about diversification, and that's not sexy. It's not fancy, but it works. And, look, diversification is a defensive play. It's not about offense. And you're never going to be happy with all of your portfolio when you truly diversify. And diversification is not what a lot of people think it means. I've had financial advisors come up to me at conferences I've spoken at, or maybe in the hallway, and they grab me and they're like, I don't understand exactly what you're talking about here, because I just tell my clients to own everything. And I've heard that a lot. I've seen that in articles. I've seen it on CNBC and Fox Business. And hey, just own an index fund and own everything. And that's not really what we want to do. Because look, what we know from reams of data is that there are some asset categories that are just going to outproduce others over long periods of time. We have expected returns that we know, for instance, small cap will beat large cap stocks over long periods of time, or at least they have. I just don't know when they're going to. I don't know when that risk premium is going to present itself. I don't know when international stocks are going to outproduce domestic stocks. I don't know when value stocks are going to outproduce growth stocks. We don't know these things, and we don't try to predict them. What we do know is that, again, with reams of data on security prices and the movements of such, that certain asset categories tend to outperform others. And that's how we build diversified portfolios. And it's showing up this year in spades. It's really helpful in a year where we've got some really ugly data out there. So I've got my very tech savvy little note card here of year-to-date data. Year-to-date as of today, which is April 24th. This is actually as of close of business yesterday, April 23rd, 2025. All of this data is coming directly from Yahoo Finance. You can go Google it yourself and look at it. And they're all indices. So none of this is any kind of proprietary mutual fund or ETF. None of this is specific to the portfolios that I build you guys. This is like general data. But it really does substantiate why we diversify the way we diversify and why it's okay for you to open up your statements this year. So U.S. data first. Ugly. I'm going to round some of these numbers. The S&P 500 year to date's down about 9%. Now, for some context, that will put it on pace for, a 30 plus drawdown, negative drawdown, if it continues. I'm not saying it will. I'm just saying that if it did, you're on pace for a 30+% downside. The NASDAQ is down 13% year to date, and the Russell 2000, which is small cap growth US, is down almost 14%. These are ugly numbers. And I'm not saying they can't turn around. I have no idea. Like I said a million times, look, I'm not a chameleon. I'm not going to change my principles on you. I'm not going to change the story I've told for almost 3 decades now, which is that we are not going to time markets. We are not going to stock pick. We're not going to be that chameleon which chases the hot hand. That's speculation. That's gambling. You do not want me gambling with your money. I'm not going to gamble with my money. And there's no need to, because the returns are out there. We just have to build our portfolio according to the science and the math. And that science and the math tells us that we need to be internationally diversified, even in years where U.S. stocks are crushing international, which has been the case for quite some time. So I'll take heat from this, but again, I'm here to protect your money from years like this year. So here's some international numbers for you and why it's okay to open your statements. The FTSE, which is just basically the UK index, is up about 3% year to date. So NASDAQ down 13, small growth down 14, S&P down 9, and the UK is up 3 year to date. MSCI Europe, this is the 15 most developed European nations, that's up 12% year to date. Hello, 12%. Almost a complete, 180 degree turnaround from the Russell and the NASDAQ. What about Germany? This grabbed my eye when I was looking through Yahoo Finance because prior to this year, at the end of last year, the prevailing wisdom was that German stocks were going to get crushed this year. I mean, it was not a pretty sight out there. And I actually got some articles forwarded to me by clients saying so. And my answer was, well, look, we're not going to go in and pull out German stocks. We don't stock pick. We don't market time. We diversify. And if we're going to diversify internationally into developed countries, we're going to own German stocks. Well, German stocks, according to the DAX index, are up 10% year to date. The Euronext 100, this is just it's like a basket of European countries, not just developed, but it's not the largest of large, but everything. That's up 2. Even France is up 1%. And they've had a rough go with some tariff stuff. They're up 1% year to date. Eurostock 50, another index, this is European blue chips mostly. That's up almost 5. And my most favoritist of all of these indexes, the MSCI World Small Value Index, is up almost 13% year to date. Why is that my favorite? It's not just that it's the best return. It's almost, again, exactly 180 degrees different than the NASDAQ, which is down 13. This is up almost 13, or the Russell 2000, which is down almost 14, and this is up almost 13. The reason why it's my favorite is because in a 95% equity portfolio, which not everybody's in, but that's like what my money's in, the largest slice of that pie is actually international small cap value. And if you have 50% equities with me or 65% equities with me, of that equity piece of your puzzle, the largest percentage will be international small cap value. Why? Did we just switch it this year? No, it's been that way for as long as I've been your advisor. The reason is we are going to own US stocks. We're going to own international stocks. And in both of those geographies, we're going to, again, international, we're talking also emerging markets. Okay. So we're talking Brazil and India. We're talking Asia. We're talking Europe and the US. And no matter what we're talking about, we're going to tilt your portfolio to small over large and value over growth. That's what we're going to do. The fixed income that we've got inside there is high quality, short-term fixed income, not for yield. We're getting okay yield, because interest rates are higher, but that's not the point of it. When that was generating 1% returns, we kept it because it's not about returns. Bonds are not there for returns. Bonds are there to reduce your volatility, period. If we want returns, guess what? We go to stocks. That's a risk premium. Stocks tend to outperform bonds over time. Do they every year? No. Does small outperform growth every year? No. Or I'm sorry, small over large? No. Does value outperform growth every year? No. We can't predict when. We just know over long periods of time they have done so. So the math would dictate that we're going to tilt your portfolios in those directions. And the result this year is that if you look at a 95% equity portfolio that we have you in, if you're in a 95% equity portfolio, if you opened up your statement, you're probably flat. Yeah, it might be down 1%. Again, in context of being down anywhere from 9 to 14% in U.S. stocks, which is what you're going to hear on the news, or your brother-in-law or the people at the country club are talking about how bad the markets are, and you don't want to open your statement because you think you're in the same portfolios and you're not, because we truly do diversify. You can open your statements up. You don't have to worry about trying to beat anything or time anyone. What are we doing? The purpose of your portfolio is to fully fund your financial plan. Your financial plans have all these different hopes and dreams inside of them. So your financial plan is not to beat your golf buddy. It's not to beat the commentator on CNBC or Fox Business. It's not to say you were right, you gambled and you won, or that you beat crypto, or that you beat gold, or that you beat any market. It's not the point. The point of your portfolio is to produce the risk premiums, the returns. It's to pay you efficiently based off of the risk you're willing to take. And that's very personal to you, right? So when we sit down and we look at your plans and your portfolio, we build all that in there, and then we build the portfolio to support the plan. It's okay to be worried. It's my job to worry for you. We've said it many times. If you have fears, if you're still not convinced, you can open up that statement or that email that has the statement in it. Shoot me a text. We've got a secure texts on our at the bottom of my email. You'll see the number in there. You can text me. It's compliant and encrypted. You can email us. You can call me. My business cell phone is right there. Let me walk you through it. You're going to be okay. If you have friends and family who are cringing every time they turn on the news, with the huge swings in the U.S. stock market in specific, maybe tell them to give me a call. If they have a good advisor and a good portfolio, I'm going to look at it. I'm going to tell them they've got a good advisor and a good portfolio, and they should stay. If there are problems with that portfolio and with that plan, I'm going to tell them that too. They don't have to work with me, but they should have somebody who's willing to stand there and say, look, there's a better way to build this. That is it for today. We'll talk to you in a couple weeks. And like I said before, any questions, any worry, reach out. We'll talk to you. We'll get you on the schedule as soon as we possibly can.
Registered Representative and Financial Advisor, Park Avenue Securities, LLC, Pass OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California, 92121, 619-684-6400. Securities products and advisory services offered through Pass, member FINRA, SIPC. Financial Representative, Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. California Insurance License Number OD34103. This podcast is for informational purpose only and is not intended to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that the individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Past, Guardian, or Westpac Wealth, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid than securities of larger companies. Investing in the bond market is subject to certain risks, including market risk, interest rate, issuer credit, and inflation risk. This material is intended for general use. By providing this content, Park Avenue Securities, LLC, and your financial representative are not undertaking to provide investment advice or make a recommendation for specific individual situation or to otherwise act in a fiduciary capacity. Past performance does not guarantee future results. Indices are unmanaged, and one cannot invest directly in an index. 7898625.1 expires April 2027.